Hello everyone, welcome to the Slow and Wealthy channel. Today I want to share with you my investment thesis for the Chinese e-commerce conglomerate known as Alibaba. Full disclosure, I am currently long Alibaba. This is a company that I am very bullish on for its long-term potential. And please keep in mind that you are responsible for your own investing decisions. This is not professional financial advice. Do your own research. Also, this presentation will be quite exhaustive. So here's a breakdown for how this presentation is going to go. First, we'll do a brief business overview on what Alibaba is and what they do. Then we'll do a statistical rundown, looking at the most important numbers and ratios. Then we'll do a more in-depth analysis regarding Alibaba's business and future growth potential. Then we'll look at the risks involved when investing in Alibaba. Then we'll take a look at the current price and come up with a fair value and expected future value for Alibaba. And then I'll wrap up with my final thoughts regarding Alibaba as a long-term investment, taking into account the risks. So here's a brief business overview of Alibaba. So they're often called the Amazon of China. Alibaba is a fast-growing e-commerce conglomerate headquartered and incorporated in China, and most of their business comes from China as well. As of Q4 2018, it boasts an estimated 750 million monthly active users across all its platforms. This number is expected to continue to grow at a fast pace. And this is one of the many reasons why I'm very bullish on Alibaba for the future. They already have 750 million users, and this can keep growing by the hundreds of millions more. China is a huge market. And finally, Alibaba has plans to continue expanding its core business outside of China and break into new industries as well, most notably cloud computing. And part of this is they're going to expand into e-commerce in Southeast Asia, adding hundreds of millions of more potential customers. All right, so now here's a brief statistical rundown. The current price is $159. Now this has recently taken a hit due to President Trump announcing new tariffs on China, and now it seems that China and the US seem further away than ever on a trade deal, for now at least. And also due to the yuan being devalued as a result of that latest announcement, and since Alibaba reports in dollars on the New York Stock Exchange, that also took a toll on the price. Its current market cap is $414 billion. Now, I'll go into this later, but this is a company that is basically the same size as Amazon in terms of revenue. It has the same growth statistics, growth potential, and it's doing basically the same thing that Amazon is doing. It works in the same industry as well as breaking into cloud computing, so very, very similar to Amazon, and it's trading for about half the market cap, at around half the market cap. So, and then you look at the trailing PE, it's only 32 compared to Amazon's like 75 or 80. Its forward PE is between 18 to 23, with a forward 5-year growth rate of 20 to 30%, which is just amazing. And then it has a trailing 5-year growth rate at 49%. In fact, last year they grew at 60%. All right, so here's a breakdown of Alibaba's main business segments. Let's start on the far left with their core businesses. 1688.com is a website, a platform where Chinese factories and businesses hook up with other Chinese businesses and retailers and buy and sell in bulk. Taobao Market is very similar to Tmall Market, and Alibaba is working on integrating these two, and they already have to some extent. Taobao is where Chinese retailers sell to individual Chinese consumers, and Tmall is for consumer-to-consumer transactions. And Alipay Services it's a very large, very popular platform within China. It's a payment service that the Chinese people use to pay for everyday items such as groceries or restaurant visits, and of course to pay for goods that they order through any one of Alibaba's many platforms. And then internationally, there's Alibaba.com. This is where Chinese factories sell to Western retail stores in bulk. Or not just Western, but other, from all over the world. AliExpress is quite similar. It's for drop shippers, so people who have drop shipping companies and websites in the West or throughout the world and want to buy in bulk from China, they use AliExpress.com. and Lazada. Lazada is probably the least well known but very important segment of Alibaba's businesses here. Lazada is the largest e-commerce site in the Philippines, in Thailand, in Malaysia, and in other Southeast Asian countries. And Alibaba has, I forget exactly, but between a 50 to 60% stake in Lazada, so a commanding portion of the market. So, Alibaba already has big plans to break into Southeast Asia e-commerce with Lazada. And then finally on the right side, the other segments. So Youku is named after YouTube, so it can be thought of as the Chinese equivalent, a video streaming site that Alibaba owns fully. Cloud computing. Cloud computing is actually their fastest growing source of revenue of all the segments. And Alibaba is also making inroads into media. So you look at all of this, and this is truly a behemoth of a company. They're really in everything, especially e-commerce. Anything related to Chinese e-commerce, Alibaba is already dominating and will continue to dominate. Alright, so the next portion is a breakdown of their revenue here. So the core commerce, it derives 86% of Alibaba's revenue. Cloud computing, they make 7% from this, and this is actually up 93% from the year before. So like as I said, it's the fastest growing segment and it will continue to grow very quickly. Media makes up 6% of their revenue, and the other 1% is everything else that Alibaba does. One good example of this is they're working on setting up websites and helping other grocery stores and other retailers establish delivery services to consumers. So really, they're really seeking to dominate anything that has to do with e-commerce and internet. All right, so here's an analysis of their growth and how they can sustain their growth into the future. Domestically, China has a population of 1.4 billion people, and they currently have about half of these Chinese people, 700 million of them, are currently using one of Alibaba's platforms actively. China's current middle class is 300 million people, and this is projected to double in size to 600 million within the next 10 years. And throughout these next 10 years, China has a projected GDP growth of around 5 to 6%. And many analysts, or not analysts, but many people in the media are all preaching doom and gloom, how the Chinese economy is slowing, 5 to 6% growth, it's anemic. But this is just natural. And I mean, China has been, for the last several decades, China has been at like 10% growth, which is incredibly fast, but it's also unsustainable, and it's also characteristic of developing economies. If you look at other developing economies, they're also growing at around 10%. It's very natural that as China, as any country becomes richer and wealthier, the GDP growth rate slows in terms of percent. And people talking about how 5 to 6% is slow. I mean, look at Europe or the US. US is maybe 2 to 3%. Europe is like 1%, very, very slow. So 5 to 6% is plenty healthy for a country like China. And then internationally, Lazada, with access to Lazada and the countries that Lazada operates in, that's another 600 million population potential customers out of that. So a lot of room for future growth. Lazada's already the largest e-commerce site in many of these countries, as I've already mentioned. And these countries are expected to sustain GDP growth of also around 5 to 7%, in line with China. And AliExpress, the international shipments, and cloud computing are another great sources of future revenue. So basically, despite already having hundreds of millions of active users, there is still room to add hundreds of millions more, all of whom are getting wealthier and fastly developing economies in China and throughout the rest of Asia. Alright, so now let's go over some of the main risks and things to watch out for when investing in Alibaba. So the first one is the macroeconomic concerns in China's slowing economy. I've already talked about this in the last slide, but I think a big reason for why the stock price is so depressed is this many investors are fearing the news about China's slowing economy, and honestly, I think this risk is way overblown, and it should barely be a consideration. I think China is going to continue to grow at a good, healthy pace, and Chinese consumers are going to continue to spend more and more on Alibaba. So this one, I'm not going to say disregard it, but it's given more weight than it ought to be. Okay, so geopolitical concerns and trade war. This might be a cause for concern, but not as much as I believe it's impacting the current stock price. Because remember, Alibaba mostly deals in China with Chinese companies to other Chinese companies. AliExpress and Alibaba.com, the international segments of its business, are important, but they're only a fraction of it. Its core businesses are operating within China and in the future Lazada, throughout Southeast Asia. So the geopolitical concerns and trade war, it'll affect their business somewhat negatively regarding Alibaba.com and AliExpress, but not as much as I believe is fairly reflected in the current stock price. So these first two, I believe, shouldn't be disregarded, but they're certainly overblown, I think. The currency is another thing to watch out for. The relative strength of the Chinese yuan to the U.S. dollar will play a role in Alibaba's fluctuating price. But honestly, I don't think it should be given too much thought to. It's already the Chinese government is already stabilizing it at its current levels of 7.1 to 7.2, and they don't want to see it go much higher, because then inflation would increase and capital flight would happen within China, and that's not something they're really looking forward to. So, and currencies go up, they go down. So it's something to keep in mind. But again, it doesn't really affect it doesn't directly affect Alibaba's core businesses. So share dilution. All right, so this is something that needs to be talked about, and I think many people talking about investing in Alibaba don't go over. So Alibaba, the amount of shares increases by about 0.5%. It's increased by about 0.5% for the last 5 years. So this does play a role in diluting the earnings per share. And there's also some big news. So last month in July, Alibaba shareholders have voted on an 8-to-1 stock split of Alibaba stock, which will bring the current price to about $20 when this does happen. And it will happen sometime this year. So that plays, and then also Alibaba is also planning on a Hong Kong listing. I think they're still planning on it despite the turmoil in Hong Kong, but we'll see how that goes. So in the short term, this could be a negative on their stock price, because the increasing amount of shares and another listing in Hong Kong will further dilute the amount of shares out there and lower the earnings per share. But in the long term, there's hope that the double hit of an 8-to-1 stock split with a Hong Kong listing will get many more Chinese investors, average everyday Chinese people, investing in Alibaba, which would be a great source of future revenue for the company, and a great driver of its stock price if it does pan out as expected. So this share dilution, it's a double-edged sword. In the short term, it does pressure the earnings per share and therefore the stock price. But in the long term, with the 8-to-1 stock split and the planned Hong Kong listing, and if that goes according to plan, it'll give more Chinese people access to investing in Alibaba, which would be a good thing for us as Alibaba investors. All right, so the Chinese government in general, and this is just an unavoidable risk for investing in China. They can be kind of opaque, unclear, unpredictable, and mostly all-powerful when operating within China. So it's just always something that you need to watch out for. They might choose to regulate something or limit a certain industry or growth. But on the bright side of this, sort of mitigating this risk, you don't get to grow to Alibaba's size without having a favorable relationship with the Chinese government. And in fact, Alibaba's founder, Jack Ma, has recently been inducted as a member of their Communist Party. So this is good news for us, for people who want to be long Alibaba. The Chinese government's always something to watch out for, but currently Alibaba seems to have a cordial relationship with the government, so that's good news there. Third-party subsidiary. So foreigners who invest in Alibaba don't actually invest in the company directly. We invest in a stake in the Caymans, a third-party company, variable interest group, and this interest group supposedly owns Alibaba, and we own a portion in this group. Please research this further, and it's a risk. The Chinese government might at any point in time invalidate it. It's highly unlikely, as this would this would very much hurt China and Chinese investment and capital flight. But they might always do something wonky and funny with it. So this is something to keep in mind, and please do further research on this risk. And competition, domestic and abroad. So Amazon is also trying to break into Southeast Asia. Also, there's other local homegrown competition there. And within China, there's JD.com that might also pose a risk to their core business. So this is also something to keep in mind. All right, so in this slide and the next slide, I will go over a fair value and an estimated future value for Alibaba. So currently, I believe a fair value for Alibaba would be around $280, which would be about a 75% upside from where it is now. Now, here's how I justify this, and I'll go over it more in the next slide. But it's currently undervalued relative to Amazon by 50%, despite having very similar business models, current revenue and earnings, and potential growth. It's undervalued relative to its own historic price, despite vastly improving fundamentals. So the stock price has gone nowhere in the last 2 years, despite increasing revenues by around 50% year over year. And its current price is being held down by recent macroeconomic and geopolitical developments, both of which, as I've already said, are overblown regarding China in general and especially regarding Alibaba's core businesses. So as I've said, Chinese economy is going to do just fine with 5 to 6%. Chinese consumers will continue to buy increasingly more, or will spend increasingly more on Alibaba. It's not going to affect their core business. Remember, it operates mostly in China. And this is all assuming, by the way, that the situation between China and the US doesn't cool. So let's say China and the US continue to have these tariffs indefinitely on each other. Alibaba will still be poised to do well. And if in the future things lighten up between the two countries, then I can just see the stock price taking off, as these things holding down the price, which are holding them down more than they should be, will be totally lifted once these concerns are over. It'll just unlock the share value and price. And the political risks are real and must be priced in. So regarding the Chinese government, the third-party subsidiary, and all that. So there should definitely be a discount. You should definitely account for that. And the share dilution is an unknown variable. I mean, I believe in the short term it will continue to put downward pressure on the stock, but in the long term it could potentially be very positive, but it's still unknown how this will turn out. Alright, so here are some future value calculations for Alibaba's share price. Its current price is 163 or 159 if you count the after hours. Current earnings per share $4.97, and its current PE is 32. So on the left side now, if we assume 25% growth, which is the midpoint of between 20 to 30% for the next 5 years. So assuming 25% growth for the next 5 years, that'll bring us to a earnings per share of $15.25 by Q1 of 2024. So now let's assign, if we assign various terminal trailing PEs, we see where the corresponding stock price will be. It's currently at 32, which who knows if it'll go much lower or higher than here. But if it was anything like Amazon 70, then this would just completely blow it off the chart here. But assuming it stays roughly the same where it should, around 30 to 35 as the business matures and slows down in growth, that still gives us a terminal trailing PE of around 457 to 533. And assuming a bearish case, maybe we slow down further than expected, or maybe a recession in the road, and there's a terminal trailing PE of 25, that still leaves us with a share price of 381 compared to today's price of 160. So I think no matter how you cut it, this is a very good value buy right now. And the current price, I honestly don't see it going much lower. It reached 140, I think a bottom of 141 in May, the first time Trump voiced concerns about reaching a trade deal with China. And I don't see it going much lower than that, unless China decides to roll tanks in Hong Kong to quell the unrest there. But so I definitely think it's undervalued right now. And there's certainly amazing upside potential here. Alright, so here are some of my final thoughts for investing in Alibaba. Alibaba is very undervalued fundamentally, relative to Amazon, and relative to its own historic price. Overreaction to recent developments are unfairly holding down the price, as well as fear and ignorance around investing in China. more to this point, many people are scared of investing in China, or they don't know much about China. They have this impression that Chinese companies are inherently unreliable, and this is certainly true for smaller companies. But a large company like Alibaba, they can't really get away with fudging their numbers. There are thousands, maybe tens of thousands of analysts keeping an eye on Alibaba, and it's definitely the scale and legitimacy that Alibaba has achieved. It's certainly not in their best interest to fake their numbers, and as I said before, they can't really get away with it. So I think, but many people are understandably skeptical about investing in a country like China, but I think this is a little unfairly holding down the price as well. Certain political risks are legitimate and must be priced in, perhaps a 15% discount, taking into account the Chinese government, Chinese political conditions, and the third-party subsidiary risk. But overall, with its business model, track record, growth potential, and at current valuations, investing in Alibaba is an excellent way of profiting off the continued economic growth of billions of people throughout China and Southeast Asia via a booming e-commerce industry. So more to that point too, I think Alibaba is a great way for anyone who wants exposure into China, and I believe, if you're smart, you want exposure into China. They've grown very, very quickly the past few decades, and they will continue to grow quickly. They have the numbers, they have the pace, and any bearish news about China, their slowing economy, 5 to 6% is not slow at all. And they have the numbers, they have the population, and we know e-commerce. It's not like a brand new industry. It's tried and tested. It's been proven to be very popular in the U.S. and Europe and throughout the world. China is no different. It's already very popular, and it will continue. Chinese consumers spending on e-commerce on Alibaba will continue to grow in the future as the Chinese economy grows as well. So Alibaba is a great way of capturing the growth of hundreds of millions of people throughout Asia. Anyway, thank you all for listening very much. Much appreciated. Let me know what you guys think in the comments if Alibaba is a good investment. See you all next time.